I will do a series of lectures, and they will be posted as a separate modules, recorded modules, and reason for having multiple modules is so this way student do not have to go listen to the whole thing if they just need a refresher after listening to all of them once. And so as I go through it, I will stop and then start another module and continue. And hopefully that would be helpful for you all. So the series basically encompasses assessing financial health of the company. As a business person, one of our charter or one of our responsibility is that we look at our business, or if we are working for somebody and we are looking at their business, or if we are looking to participate in a business by investing, or if you were lending, what are the things to look for to be able to give us some idea, some guide to if there are any issues, what are they? And with that conversation or the analysis could lead into if there are issues, how bad they are, in the sense that are they average or they below average, and eventually the end goal obviously is to figure out what does a business leader do to be able to make the health of the company better. Okay, so that really is an intentional series of modules. So there would be modules will be broken up into three categories. The first category will be the ratios, which is the focus of this recording, and even included in the ratios, I will break up the ratios lecture into three pieces. This way, again, you can further break down your module to do that. The primary focus will be on the ratios, but I will touch on the trend assessment and common sizing, something that you will need not right away, but within a week or so. So I'd at least want to talk about a bit. All these three items, the ratio or the trend assessment and the common sizing, are all part of the reading assignments in the textbooks, and hopefully this recorded lecture will help augment anything that you may be struggling with, any learning gaps you may have, and or would provide a slightly different perspective when you are obviously watching a PowerPoint and also listening to some commentary. So the combination of these recorded lectures and the reading that you have already done hopefully will get you to think it through. So let me start out with just a quick overview of what does it mean when the textbooks talk about trend analysis, and what role does that play as far as looking at the financial health. So here is an example of an income statement, and I think, as you know by now, income statement would include your sales and your cost of goods sold, and any SG&A, and in some businesses you may have other costs like engineering and so on, and you got depreciation, and then from there you get into earnings before interest and taxes, and some companies may call that operating profit, and basically what this point is, you're taking a snapshot, or you're taking is looking to see where you are after you've looked at your sales, your costs, and that's where you are. Then you will have the interest expense, the taxes, and the net income. So this is a typical income statement, as you know. So now that we know what an income statement is, what we are now adding as far as learning as a business leader, as a in terms of finance part of the business leader, is to look at the trends and see if this analysis is telling us something. So what is this telling us? So let's look at starting with the sales. Trend, obviously, the focus is on trend. So the trend is that the sales are going up, you know, and now if you want to look at this time frame in this example, let's say this one is a 5-year time frame, and one can also look at a 2-year time frame, one can look at a 3-year time frame, but this data over here is shown as a 5-year time frame. So what this is saying is that if I would look to see how much are my sales growing on average annually, like on average annually, how much are they growing? They are growing 8% a year. What does that mean? What that means is if you start from here and you compound this 8% every year, that's where you're going to end up. Now that does not mean that every year is going to be exactly 8%, because if you look at it, you will find some years may not be exactly the 8%, some may be higher or some may be lower. But if you're looking at the trend over a period, what you're really seeing to say, on average, what is the compound rate? You can do it with your, just basic calculation on a calculator, or you can use Excel, to be able to do that. The cost of goods sold is a cost to make things, as we know by now. And if you look at this thing growing over the 5 years, look at the average compound. This is saying on average between 2004 and 2008, the cost of goods sold are growing at a 10%. So this right away is a telltale. This is right away is something to ponder over. That our costs are growing at a much faster rate than our sales are growing, which means that with time, the margin between the sales and the cost will get smaller and smaller. And as we know, if we have money left over from sales to minus cost of goods sold, it's obviously going to start to affect our net income too. So right away here, this would be a source of conversation, is to say, why is the cost of goods sold going up? And from a strategic planning or any planning, one will have to start thinking about is how do we make a cost of goods sold not grow as fast, so this way we do not have a negative effect on net income going forward. And so companies will start to look at things like, how do we do some process plan improvements? How do we make things better? In some cases, they may even look to outsource things to a cheaper place, or move their factory from a more expensive state to a less expensive state, or even a less expensive country. Okay. If I look at other categories of costs, in this case, they're telling us the SG&A and admin costs, and obviously that is growing even at a much faster pace. It's growing at 12%. So that is again to say, okay, if our sales are growing at 8% and our first biggest cost, which is 11.4 million out of 25 million, which is almost like close to 40+%, is growing at 10%. Our next big cost is here, and that is growing at a 12%. And there could be good reasons for it. A good reason could be is that maybe they have a new product, they have added some more people that are selling it, maybe there is more marketing going on, maybe there's more advertising going on. But one would not take that for granted. One would ask the question is to say, why are our selling, general, administrative costs going up? And if there's a clear strategy that this will help in the future grow the sales at a faster pace, that may not be a bad thing. But just looking at this thing, as a person looking at this chart, it just raises a question to say, our SG&A is going up pretty fast, okay? Depreciation is a smaller number, and again, this is really tied to our investments we're making, and it's gone down slightly a little bit. So it's, again, because it is small, by itself it doesn't mean much. But if you dig deeper, and you say that the depreciation was 1.3 million and is now down to 1, which means on average it has been going down 3%, 3.8% a year. So a first gut reaction could be to say that's a good thing because their expenses are going down. But if you really think deeper and ask yourself a question, that depreciation is, as we know by now, is you're expensing your longer term assets over the time. And if the depreciation number is going down, would suggest that the company is investing less in larger assets. And is that a good thing or a bad thing? It may be a good thing to say maybe they started the company, they had to make some major investments, now they got some new machines, new factory, they don't have to do it. On the other hand, if it is an older business and have not been investment, this could be a red flag in the sense that this company may not be investing enough in their equipment, and maybe that could be one of the reasons why the cost of sales are going up. So that's what you start to think about it. This line, EBIT, is really nothing more than obviously taking the sales and subtracting the cost so far, and that is growing at a 2.5% rate. Now, 2.5% by itself is not a bad number, at least it is a positive number. But the telltale here is that sales are growing at 8%, and this is growing at a 2.5%, which means if these things over here, which are the two largest costs, continue to grow at a much faster pace than the sales, this number eventually could become negative. What do I mean by that? So let's say if you're looking at sales and the sales are growing at this pace, which is 8%, for example, okay, cost right now obviously here, so there is this profit right here. We are making money, okay, but if the costs are going to grow at a faster pace than the sales are growing, this is your sales, and this is all, these are the costs, SG&A combined. So what's going to happen is, yeah, today we are making all this profit, but eventually we could be in a problem, which means that eventually a cost may cross over our sales because the sales are growing at a slower pace. So that's an example of how you would look at the data and kind of make some conclusion. So obviously at the end of the day, you can see net income is growing at a slower pace and the cost is, so something like this is very, very plausible. So I hope this is helpful from a trend perspective, okay? Next thing I want to touch on is what is called common sizing or normalizing. And there are words in the screen, left wordy, you will have the PowerPoints, separately so you can print it out. But it is another way to look at the income statement and the balance sheet and you common sizing it. What that basically means in plain English is that this methodology will allow you to compare 2 or 3 companies. They may not be exactly the same size. For example, you could have a company that has a sales or revenue of $100 million, and in the same industry, you may have another company that have a sales of $1 billion, so it is 10 times bigger. So if you want to compare company A with the company B and you start to look at their profit by itself, obviously the company A will have less profit versus company B. So recasting it or common sizing it or normalizing it basically helps you do that. So I'll show you an example. What do I mean by that? But at least what you want to do is to think that, okay, how do I use this methodology to, again, look at the financial health of the company. So let's look at the income statement. On this chart, there are 2 companies with their individual income statement. First company is called Cogswell, and Cogswell has a revenue. Again, this is income statement. Your revenue, your cost of goods sold, you have some SG&A, you got depreciation, then from you take a subtotal EBIT, interest expense, and so on. Okay, and then you get the net income. So Cogswell is a company, and again, they're both in the same industry. When you're comparing a company A with company B, obviously you want to compare apples and apples. What do I mean by that? You cannot compare a Ford Motor Company with, say, Google or Intel. You can compare Ford Motor Company with GM or Toyota or Honda. So that's why when you're comparing company to company, you're really comparing apples and apples. So you have to compare it with somebody in the same industry. So here are 2 companies, Cogswell and Spacely, both in the same industry. Cogswell revenue is $25 million and Spacely is $8.4 million. The net income for Cogswell is $3.3 million and for Spacely is $857. So obviously, just looking at it, this number is bigger than that number, obviously, because it's a smaller company. Now, the question is, how does one make comparison? So what does normalizing or, common sizing means? Normalizing and common sizing basically means that we would look at the cost, all the costs that are in our income statement, and compare it to revenue, which means that revenue is 1 or 100. So in this case, cost of goods sold, if I divide the 11,497 by 2512, I will get 45.78%. So what this is telling me is that in this business, 45.78%, or for every $100, $45.78 are used for doing cost of goods sold. $29.69 are being used for SG&A. And that basically, this is this basically says that if I look at these two and add them up, almost 46% and almost 30%. So you got 46 and 30, just 76% of your cost is tied up in these two categories. And hence, obviously, if you were looking at it to make it better, efficient, so on, that's what your target would be. From EBIT perspective, it basically says that obviously we're left at 20.9 and so on. Now, if I look at the other company, they are spending 48.85% or $48.85 for every $100 of sales. So what does that mean? That means if everything equal, this company is spending $3 for every $100 compared to this company to making their cost of goods sold. Now that could be good, bad, or ugly, but that is telling us that if everything equal, from a cost of goods sold perspective, Cogswell is slightly more efficient than the Spacely is. If I look at the SG&A, they are spending $29.69 for every 100% of sales, where Spacely is spending 26.25. Again, if everything equal, Spacely is more efficient. Now, by itself, it may not mean much. Maybe Cogswell may have a strategy to go in and do a marketing blitz and maybe do, selling and so on. Eventually, that could be a good thing. But at least looking on the surface, it looks like, one is better on cost of goods sold and the other one is better on SG&A. So that's how it helps you to normalize. It does two things in summary. One is, even if you are looking your company by itself and not anybody else, you can see where the opportunity for improvements are. They're all right here. Okay. In this case, interest expenses are very, very small. Obviously, this is a little bit higher. So you can see the opportunities basically right here where you got 75, 80% of it. So that one example. One use is to just look at the company by itself, and the second is to compare it with a competitor or a peer or a benchmark and so on. Okay. If you can do the same thing for balance sheet, normalizing it just like we did for the income statement. So for the balance sheet, we would do the same thing. And this time around, again, two companies over here. You got Cogswell and you have Spacely. And this is your assets and this is your liability and owner's equity. And as you know by now, total assets will equal to total liabilities plus equity. Same thing with the Spacely. Total assets is equal to total liability and equity. Okay. Now, so what you're doing from normalizing over here is you're looking to see the different categories of assets, for example, cash, short-term investments, accounts receivable, inventory, so on. What percent is tied up? How much is cash as a percent of total assets? So this one, it says 1638. If I divide that by 23,474, I would get 6.98%, which means almost 7%, 6.98% of the assets are in cash, which could be a good thing if they want to keep some cash. Some short-term investments they may have, it is 0.8%. Inventory, they have 10.78% tied up in accounts receivable, 5.7 to an inventory, and so on. So again, you can look at this thing company by itself and see how they are doing and see where the opportunity could be. Similarly, on the other side, the liability and equity side, you do the same thing. You're looking to look at how much accounts payable is tied up. So you're taking 6052 and again dividing by 23,474. Remember, this number and these two numbers are obviously the same. So it's saying that 25.78% is tied up accounts payable. So that's a big number for that business, but that's what it is and looks like. And that could be normal or not, but that we know that they have 25.78% tied up in that. It's a percent of debt plus equity. Long-term liability 34.6%. If you add up the total liability, 60.4%. This common stock, the retained earning, and hence the total equity. Okay, so as you can see, if I look at it from a how much liability or debt versus how much equity they have, so they have about 60% of equity and so on, and obviously this is not adding up to 200%, so there must be something small item in here also to be able to match the numbers. So overall, the learning over here is to say, okay, I can look at a company, in this case Cogswell, and kind of do normalizing to figure out where are the big ticket item numbers. Okay, and I am just going to change the pens, and also we can do the same thing this time around. We can compare the companies Spacely with Cogswell and Spacely, and start to see if we see any differences. One of the differences you see is that it's a little obvious is that the Spacely, has 11.5% of their asset tied up in the inventory, whereas Cogswell has only 5.7% tied up in inventory. On the other hand, which is a good thing, on the other hand, accounts receivable are higher here versus here. So that basically says obviously one company is doing better in managing their inventory, which in this case is Cogswell, and the other company is doing better in managing accounts receivable, which is with Spacely. So this basically is another way to use to look under the hood of a company and start to see how one would start to analyze them. Okay. So now I'm going to go and get into ratios. And these ratios, as I mentioned, I want to break it up into 3 modules, starting with the overview. And next module will be the formula that I use, and the third module is what I recommend to business people, not even the students or even people that are learning this for the first time, create flashcards, and I will give you some example of what do I mean by that, and they become very helpful as you're trying to analyze a business or you're trying to analyze a case study in the case of in a college program. So let's think about what is ratios. Financial ratios, and again, remember we are talking about financial health. So the ratios are, the purpose of these ratios are to be able to see if the company is healthy or not. So we really wanted to do some checking under the hood. We want to do, ratios are like testing in some ways to see if this company is healthy or not. It could be a situation where the patient is totally very, very sick. It may not be able to make it. That would be a situation of a company where they have a real liquidity issue in the sense that they may not have enough money to even cover some short-term expenses they have, and hence obviously that would be very, very concerning, and that's where you would want to look at some of the ratios that would be liquidity ratios that we'll talk about. Or you would look at overall health of the company to see what parts of the maybe it is not a situation where the patient is going to not make it, or at least looks in a pretty bad shape. But over here you're looking to see what are some of the areas in the companies that are doing well and some areas that are not, to do that, and you basically are checking different areas, and eventually your goal is to come up with some strategies that will help make this company better and improve the ratio. So the ratios are again under the umbrella of looking at a financial health, but here you're looking to see what is going on, and again I'm going to talk about in the next module how do you calculate. In this module I will talk about the overview, so this way before you get into the number crunching part of it, the more important part is from a holistic perspective, I would like you and obviously, all of us as business people to really understand what does this mean, because the number crunching part is easy. We can take some numbers, put in the Excel, do the calculation, but the important part is what does that mean? Just like a doctor can do multiple tests, but the question is what do you do with those results? Okay, so so the purpose, so what I'm going to do is to spend next few minutes talking about this overview part, so you fully have a full understanding of why these things are important. Okay, so the other thing I always say, think of them as like a gauges on your dashboard, both short term to see what is going on, and also the long term to see what does the trend look like for these ratios or these quote unquote financial health metrics. Are they getting better or are they getting worse? Okay, so what are financial ratios? Financial ratios are obviously the fact that they are financial. The data will have to come from financial reports. So it is the purpose of financial ratios. It allows us to do meaningful comparison across time. And across time basically means is that, let's say if you had a patient and you were, if you were a doctor, you're looking at a patient and the person had, high blood pressure or high cholesterol, and you start to do some testing, and over time you're tracking to see how they're doing. So ratios basically we can do is to look at the history of the last few years of the company and say how are they doing in these performance metrics. Okay, so that's where the time trend comes in. The second thing is obviously also helps us compare to say how are we doing against a competitor. We are in an industry, let's say if you're a Ford, how do you compare with GM and how do you compare with Toyota and Honda? If you were in a retail store business, let's say it is Macy's, and whoever their competitors are, they will compare it against themselves. If you're a Walmart, more on the low cost retail store, who do you compare with, and so on. So you can start to make comparison against a competitor and to see how do you do it. And again, just like we talked about before, ratios, we will normalize it, which means you can compare a large company with a small company, and the comparison is only useful if they are both in the same industry. And you can also look at the industry average to say, what is the average? Just like we're looking at an average of anything. So this would to say, okay, if I look at our company or the company that we are analyzing and compare it to the industry average, what does it look like? Are we average, below average, or are we best in class, which means we are the best driving the average up, or we are on the other end of the spectrum at a low average and bringing the average down. So the financial ratios are the relationship between accounts and even financial statement. Obviously, they come from income statement or they come from balance sheet. Okay. So as I mentioned, there are uses for it, and uses will fall into following categories. A, leadership or business owners may benchmark how do they compare with others. You competition, etc. How are you improving over time? Are you getting better or are you getting worse? Using it to set some long-term goals. For example, if you see the health, i.e. cholesterol is too high, what is the game plan? What are you going to do to change the diet, exercise, whatever? So what are you going to do to put your business on diet? What you're going to do is to make your, what medicine will you give your business? How will you grow your business? How are you going to make it better? So you set some targets. Let's say somebody's cholesterol is 240 and it is too high, and they set the target they should be at 190. So that becomes the target, to get to 190. And then the question is, how will we get there? Okay, and that's really what, that's what is then done to be able to look at it. Okay. So starting with the benchmarking, how do they compare? What you're really trying to do is to compare yourselves to industry average and see best in class, and how far away you are from best in class, or if you are below average, above average, at least give you some guidelines. Next, you're looking at the trend. Is the performance or the ratios getting better? Are they achieving best in class status? Are you at least getting to the average? Are you getting worse in some cases? And sometimes the investors will obviously also look at it, and they would be their reaction, what's called a price to earning ratios, and I'll touch on that when I get into the formula part in the next module. But overall, the whole idea is to really look to trend to see, is the trend getting better or worse? Investor sees somebody, for example, if let's say there were two companies that you were analyzing, and this is a one company which is in this one over here. Obviously, it is trending better. It had a bad time, maybe it was the economy. So everything, including the other company, they were both growing, and maybe this was the quote unquote the peak of the economy, and the economy came down, and so this company, they both came down, but this blue company over here is getting better. So if I was looking at, let's say, a ratio of this company, and the reason I would use ratios, not the absolute number, is because what if one company is much bigger than the other company, even though they are both in the same industry? So we normalize with using the ratios, but if this ratio for this company is trending overall better versus this is going the other way, obviously you will pick the top company or the blue company over the yellow company. Okay. So that's how you look at the ratios, compare it to you put it on you could put the calculation in Excel, create the chart, and you can make the comparison. How do companies use the ratios? They would use the ratios, obviously, as I mentioned, they would use the ratios to set some targets, to say this is where we want to go, and then they'll start to develop the strategy to be able to get better. And so they have to lay out a game plan, and as part of the strategy, as you get into the strategy courses, you're gonna look to say, okay, what strategies do I have to improve? But the financial analysis is step one to decide what part of the company we need to improve. I mean, for example, in this case, if you can read it, it says marketing strategy over here. So in this case, let's say the company was doing well in the other area, but they were not doing well with the sales. And if you look at the sales as comparing it to the other company as a percent of, say, assets or whatever, so now they got to develop a sales strategy or marketing strategy to do that. Okay. So here I'm going to stop and the recording, and my next module will start from this slide. Okay.